Yeah, please, when the question says constraint of relevance and faithful representation, what does it mean? Like, if it's asking that to state two constraints of the fundamental characteristics of financial statements.
Right, right. You know, to adhere to the fundamental code of ethics, to adhere to the qualitative characteristics of financial statements, like making sure that we disclose every relevant information that has to be disclosed. Give me a moment. Let me set this up then. Where is the sound coming from? Okay. Sorry, got some sound coming in here. Okay, so my YouTube is up now. I'm sure. Okay, so let me go now to your question, Godwin. So, you know, last week, one of the issues we mentioned was the qualitative characteristics of financial statements. And we said that when it comes to preparation of financial statements, they must exhibit these qualitative characteristics. But you see, it will cost the company money to adhere to the qualitative characteristics, and it will also require a lot of time for all the things to be ready and be disclosed in the financial statement. So when we talk about the constraints of those qualitative characteristics of financial statement, one of the constraints is cost. Okay, it will cost us money because, like we spoke about relevance, we spoke about faithful representation. If we want to represent the financial statement in a manner that has to be represented, we would have to incur a lot of cost in deciding what has to be included in the financial statement and all that thing. And we will have to, and then time is also something that is key. So cost is one of the constraints, and then time availability, because there are times when certain information may not be available when it is due that we publish the financial statements. So if we are going to wait, okay, we're going to wait to get all those information. Number one, it will cost us money. And number two, it requires a lot of time. And sometimes it is not just practical. So even though we have generally given the guideline that, oh, when you're preparing financial statement, try to be faithfully represented, try that it is relevant, try that it is comparable and all that. In reality, entities cannot accomplish all of these. And the two key things that are constraints on the adherence to the fundamental qualitative characteristics are cost and time. So when a question is put that way, then this is where you have to come in from, cost and time, because these things prevent the entity from really preparing the financial statement to meet the qualitative characteristics and also to meet the understanding of the users of the financial statements. Timothy, does that make sense?
Thank you so much. Very, very well.
All right. Any other questions, please? Any other questions? You raise your hand, I bring you up, or you put it in the chat for me if you're not excited to talk about it. Seeing some chat coming in here on Zoom. Kweku Agri said, a bit of clarification. How did ratios come as sequel to single entity financial statements? In what context is your question? Kweku Agri, maybe give me some context, then I can put your question well to have the understanding. Like when you say, how didn't ratio come as a sequel to single entity financial statements? Maybe give me some context, then I can provide you with some answers there. Oh, just give me a moment. Let me see if this person is supposed to be here. Yep. Quickly, give me some context. Let me understand your question well. Then I can provide you with some answers here. Okay, I meant in the structure of treating ratios and ethics on the same day. Oh, okay. The issue is that generally, we are looking at the few things that we need to look out for. If I want to do single entity financial statement, actually that is going to be like last but one thing that we're going to do. Because before we can do single entity financial statements, we should have done the standards. Because each of the footnotes in the preparation of a single entity financial statement, being the statement of comprehensive income, the statement of changes in equity, and then the statement of financial position and the cash flow statement, each footnote there is actually an accounting standard. So before we will come to deal with single entity final accounts, we should have done standards already, okay? And we will get into that pretty later on. Now, the reason why ratios is done first is that we want to introduce you to the ratios and then look at how we can interpret the financial statement and explain them in the context. Then later on, as we increase our understanding and do standards, then we can now merge some of the ratio questions that requires amendment or adjustment of the financial statements. By then, because you have the foundation of ratio and interpretation of ratios, when we get there, you don't have a problem again. So that is why we are treating ratios before getting into the single entity financial statement, because the single entity financial statement is actually the final part of our discussion that we were going to be getting ourselves into, the last but one to consolidation in our discussion. So that's why I'm structuring the lecture the way it is structured. Okay, so that's it about that. Quick, cool. Let me know if that makes sense. Chief Isa said, please, how do I get last week's video? You can access the videos on the study portal. I think details have been sent to you. When you open your courses and you scroll down, you will see August 2022 Zoom sessions. Orientation session is there. Then session 1, which is last week. Today's session is going to be session 2. So you can access it on the portal under August 2022 Zoom sessions. Yes, Timothy, come up.
Yeah, sure. Very quick on the last one. We know that assets and liability are recognized and measured on the face of the financial statement. But what's the difference between the two? When it said explain the difference between recognition of assets and liability and measurement of assets and liability, and said differentiate between the two. Like on one hand, so let me come clearly. The first one, the difference between recognition of assets and liability. Then number 2 is the differences between measurement of assets and liability. Like, I mean, I thought it's the same thing, but it's right. For them to put it in the same
it's not the same thing. It's not the same thing. So let's contextualize. That's a good question. Let's contextualize it. When it comes to recognition of these items as assets, liabilities, they must meet the recognition criteria as in the conceptual framework. So for instance, what the heck? For instance, assets are to be recognized when an entity has what? Control over it, and significantly, the future economic benefits of the asset will flow to the entity. So when it comes to recognition of the asset, it has to meet the recognition criteria of an asset. Liabilities also is the same thing. Liability will only be recognized when it meets the recognition criteria of a liability, meaning that it has been reliably estimated, and we'll look at this in IAS 37, meaning that there is a present obligation, and then the transfer of which results into what? An outflow of future economic benefit. So when we talk about recognition of these elements in the financial statements, it means that they must meet the recognition criteria. So assets must meet the recognition criteria as stated in the conceptual framework. Liabilities must meet the recognition criteria as stated in the conceptual framework. So that is recognition. Are you okay with that, Timothy?
Yes, please.
Then the second part, measurement. Like we discussed last week, measurement has to do with the determination of the monetary amount or the value at which an item will be recognized in the financial statement. So measurement has to do with what is the figure of the assets to be included in the financial statement, what is the figure of the liability to be included in the financial statement. So that is what measurement is about. So it's under measurement where we could use the fair value, we could use the historical cost, we could use the replacement cost, we could use the other methods in looking at the measurement. So that is a distinction. So for recognition, it must meet the recognition criteria as set out in the conceptual framework issued by the International Accounting Standard Board. But with measurement, it is about determination of the amount at which the asset or liability to be carried in the book. And there are various bases of measurement that can be used to arrive at that amount.
All right, thank you.
All right. Any other questions for me, please? Got in some interesting questions, and that is good in that case. Any other questions for me? I'm seeing a chat coming in. Kweku said, I got it. Okay. Emmanuel Onim said, please, is the app able only a mobile application? Can it be installed on a Mac? Nope, it's a mobile application. So either on your iPhone or if you're an Android user on your Android phone. So it's a mobile application, cannot be installed on Mac. On Mac, you just have to access through the website so that you can have access to the content or whatever you want to do there. Okay. Last week I gave an assignment, a reading assignment, and my soul tells me that my students are the best students in the world. And boy, you've done the assignment. Oh my God, you read the things I asked you to read. So I'm clapping for you in advance because I know you will not disappoint me. In case you have disappointed me, I will come after you very, very soon. How many of you did it? How many of you truly read through the things I asked you guys to read? How many of you did that? Genuinely, just raise your hand on the Zoom chat. Go to the emoji or the more, then you raise your hand and let me know, or give me a thumbs up if you did it. If you didn't do it, give me a thumbs down, or put it in the chat and say, sure, I didn't do it. Then I would know that you are not a good student. And I'll start punishing you before we get to the time I have to punish you. Yes, let me know. How many of you did it? Let's see. Ish, Koima, Oxbird, Senam. Your hand is up. You have a question for me? Senam, you have a question? Your hand is up. Okay. Hey, me, I'm a student. Nipa 4. Jeez. The thing that I've clapped for you like that, you are giving me broken heart already. Ish, Charlie. I have to hold my heart too because it's precious. I have to hold it right now. I have to be careful. Who is giving me a thumbs down like that? Can't even see the person. Oh, Godwin, God bless you. You are truthful. Yeah, Roger also, God bless you. You are truthful. This is called integrity. You see, you're a professional accountant. So even if you're lying, you have to say you're lying. Do you understand? So that we know you are lying. And that is what we're going to get ourselves into today. For those of you who did not join the class last week, or have not had time to do that, please take some time to look at that very well, because these are things that time will not permit me to do in class. That is why I entreat you to read them. Like I mentioned last week, primarily, this is going to be my source document, my source notes. It's a book on financial reporting, and it's 120 CDs. We've had great response from the people who have bought it so far. The user-friendly nature of the book, the simplicity of the explanation of everything in the book. So you can get a copy if you want to. You give us, you send a message on WhatsApp. We can do delivery for you wherever you are at 120 cities. But hey, if you have any other book that you're comfortable with, you can just stay with that and you should be good, okay? Like I say always, I don't force students to get my books because I don't really write the books to make money out of them. So if you are interested and you don't have a book and you want to get it, fine. But if you have any other book that you want to stay with, come on, just stay with it, all right? You'll be good at the end of the day, and hopefully you'll be able to move along with us. Okay, let me see. I still got some chats coming in on Zoom. Forgive me, sir. Today is my first day. Okay, don't worry. You can watch the video. Mame Bilson said, I read of the stages of development accounting standard. Oh, that's nice, Mame. Congratulations. Thank you for reading that one. And make sure that you keep on reading it at regular intervals so that in case it appears in the exam or you'll be able to answer. Please, what's the assignment? Oh, it was to read a couple of things last week. When you watch the video, if you're asking this question, it means this is your first time or so, something like that. When you watch the video on the portal, you'll be able to get access to that. Please tell us the topics, the assignments covered. We want to read like the stages of developing of accounting standards. That was one of the things that I asked you to read on. Users of financial statements. That was also another thing that I asked you to read on last week as well. And if you watch the full video of last week, you will be able to get access to the entire package and know everything there. Okay, so let's get excited and let's begin the journey for the day. Like I mentioned, we are looking at ethics. That is 10 marks in the exam hall. The examiner hasn't really crossed the 10 marks or hasn't gone to 10 marks so far in the various examination diets when it comes to dealing with ethics. So technically, we are looking at 5-6 marks question coming in the exam hall for us on ethics. Then 15 or 20 mark question coming in the exam hall for us when it comes to ratios, that is evaluation of financial statements. So my objective or goal today is to assist you to potentially score around 26 marks in the exam hall from the ethics and also from the ratio analysis. And I want you to stay with me pretty carefully. If there is anything I explain that you don't understand, if you smell that I'm rushing a little bit, you just indicate and raise your hand. So you say, Nhyira, take it easy, slow down. You are highly spiritual. Then I'll slow down because I want you to make sure you understand everything very well and make sure that you'll be able to do the assignment because you'll be given an assignment today. And as you know already, no contribution, no job. And we'll get into that later on. So let me share my screen and let's get excited about it. Timothy said, I didn't actually read it, but I solved questions on the reading assignment. I scored majority of the questions, so I didn't read again. Okay, that's fine. That's fine. Once you are able to like have a knowledge about it and solve questions relating to it, I mean, you are good. You are good to go in that case. So let me share my screen and let's get excited about it. Coming up. Oh, Nhyira. It's like my screen doesn't want to come up. Give me a moment. Let's see if I can bring it up. Okay. Different Wi-Fi. So what the heck? All right, coming up. Okay, there we go. Right. So code of professional conduct, that's what we want to look out for. And it's, like I said, going to be very crucial for us for our discussion in the exam hall. Like I said, it's operation 6 to 10 marks going into the exam hall. Maximum of, we've just seen the examiner just doing 6 marks in this area, but potentially it could be 6 to 10 marks coming in the exam hall that we need to be mindful of. Remember the issue about conceptual framework we discussed last week, the qualitative characteristic situations, and those change is also or are also together another 5 to 10 mark area that the examiner may shower some blessings on for you. just to give you an idea of what I mean, the just ended examination financial reporting, this is the script for the just ended examination financial reporting. And the examiner brought a question on the single entity, 20 marks, definitely. That's going to be there. We're going to get into that later on. Ratios was a whooping 20 marks last semester in the April 2022 examination. So that's why we're going to pay attention to that very well today and ensure that we understand everything in that case. Then we saw the conceptual framework, qualitative characteristics issues, 10 marks coming in. That was what I was telling you a moment ago, that the things we discussed last week, potentially about 5 to 10 marks are going to come in the exam hall. So you have to be mindful about the discussions we went through last week, because it's a done deal, 5, 10 marks that examiner is going to be showering blessings on you in the exam hall. So that is there. Then certainly ethics, what we want to look at momentarily today. It was a 5 marks question, very simple, straightforward question that the examiner brought to students or brought in the last examination died in that case. So that is the structure of the exams generally. So issues about those basic issues are going to be there one way or the other. And as you can see here, 10 marks. So it is prudent that you make sure you understand those things we discussed. And most importantly, the assignment that I gave you also, there are another areas under the conceptual framework and all those things that the examiner can throw a question at you for between 5 to 10 marks. And like I say always, if I know something is a done deal in the exam hall, I want to make sure that I understand it pretty well and answer it. So that is it about that. So last week, 10 marks. This week, we want to go to potentially 26 marks. That is the ratios and the ethics. And I'm hoping that we'll be able to achieve that goal today in the next 2 hours, 20 minutes. So let's go. Code of ethics. I'm seeing somebody write in a chat in my Zoom. When you say last one on conceptual framework. If a contract is expected to be delivered in 2 years and payment on delivery, is there an asset and liability to be recognized? For asset, I know that no, but liability, I'm confused. If a contract is expected to be delivered in 2 years and payment on delivery, is the entity the one executing the contract, Timothy? Is the entity doing the work to receive the money, Timothy?
They are receiving the goods.
Okay, they are receiving the goods.
Yes, please.
And okay, if they are receiving the goods, they've signed a contract, and the job will be delivered in 2 years. Yeah, once they have signed a contract, there is a liability. So the contract is an evidence for liability. So they have to provide for that in their books, so that ultimately when the service is provided, then they can wire that from their liability accounts to pay for the service coming in. Does that make sense? Yes, so they recognize a liability because it meets the recognition criteria of liability as per the conceptual framework and IAS 37. So they can recognize a liability evidenced by the contract and provide for it. So in 2 years' time, when the service is provided, they will just move the transaction from the liability account and recognize it as an asset or write it off in the P&L account, depending on what kind of service or contract they are engaging in.
So say that means that the asset there is still no.
For the initial recognition, I mean, the thing is in progress, but it depends again on the context of the question. If it is that they will take ownership, okay, and be using the asset as it is being constructed, then that is a different game. Then that one, we will recognize both asset and liability. Okay. Did you get that? So if we are going to, so let's say it's a building and we are occupying the building and we are using the building as it is being constructed, then that one, since we are putting the building into use, we will recognize the...
No, say, no asset now, no.
Yes. So then no asset should be recognized.
Okay.
So no asset is recognized, only liability.
Thank you.
Right. Roger said, please, where did you put the last week assignment? Because I didn't see it. We talked about it in class. We didn't put it anywhere. It was just a reading assignment that was given on conceptual framework that when we discussed that I told you to read a couple of things. So it wasn't posted anywhere. It was just a reading assignment that was given. All right, so let's jump straight up into our discussion for today. Okay, so as professional accountants, generally, our behavior has to be controlled to ensure that we do the right thing at all times. To ensure that we do the right thing at all times. So the question we ask ourselves is, how do we control the behavior of professional or of the professional accountants? Usually there are two things that governs the behavior of the professional accountant. So the conduct of the professional accountant, is guided from two sources, rules and then ethics. Rules and ethics. So the way we prepare financial statements, the way we recognize transactions, the way we handle various issues we face in our journey as professional accountants, it's guided by rules and ethics. Generally, rules can also be divided into two if you want to. We are what we call legal or the law, and we are what we call non-legal rules. Non-legal rules and regulations. So when it comes to our conduct as professional accountants, it is going to be guided by rules and by ethics. It's going to be guided by rules and by ethics. Very important. Under rules, there are what we call legal or the law, and then we also have what we refer to as non-legal rules. So the question we then, what it means in a nutshell is that there are three sources of guiding principles when it comes to the conduct of the professional accountant. So there is the law. Now, the law generally is seen as the highest law of the land, the Constitution of the Republic of Ghana. We are in Ghana, so put some respect on our Constitution. So the highest laws of the land. So the Constitution, the 1992 Constitution of Ghana. Not only that, also various acts of parliament. And the Institute of Chartered Accountants Ghana has enacted a new act that governs the way accountancy is supposed to be carried out in Ghana. So when it comes to your conduct, when it comes to your behavior, first, it has to be legal. You must abide by the laws of the land, the criminal codes, the acts of the Institute of Chartered Accountants Ghana. That is the first thing. The second thing is non-legal rules. Now, note that the rules, the legal rules, if you breach them, you know what is going to be doing. The breach of this results into a punishment. The breach results into a punishment. And this punishment can stem from various sources. It could be jail, it could be fines, it could be penalty, it could be various other things. So that is the first thing, the rules, the laws of the land. But also in our conduct as professional accountants, there are what we call non-legal rules or regulations. These are general principles, general or international principles, general international principles issued by the ICAG, that is the International Federation of Accountants, and other bodies to regulate the conduct of the professional accountants. To regulate the conduct of the professional accountants. Are you getting it? So these are non-legal. Why? Because they are international. Why? Because they are generally accepted. Okay, so I mean, these ones, if you breach them, nobody will technically come and jail you or something like that, because I mean, it is international. It's not grounded in law. Only that many of these internationally accepted general principles can find themselves in the law. So if you think, oh, if I don't adhere to the code of ethics, if I don't adhere to the IFRSs, I am free to go, you are a liar. Because the act, the Institute of Chartered Accountants Ghana Act, will have some or has some of the issues that are covered in some of these things. But primarily, our behavior is also governed by various things. So that is why we have the IFRSs or the IASs issued by the International Accounting Standard Board. Then we have also the Code of Ethics, which it is something we're going to really expand on in a moment. And that is issued by the International Ethics Standard Board for Accountants, ISBA, the International Ethics Standard Board for Accountants. So these are not rules, okay? They are general international principles, generally accepted principles that should govern the way financial statements are supposed to be prepared, and also how the professional accountant is required to act. Does that make sense? So the International Accounting Standard Board is there to issue IFRSs and IASs so we can prepare financial statements. Then the International Ethics Standard Board for Accountants is also there to issue code of ethics in order to guide us in the preparation, in the carrying out of our duties. We also have the International Audit and Assurance Standard Board. They are there to also issue auditing standards, the ISAs. That is the International Standards on Auditing. You don't need that. You'll get into that later on when you get to level 3 and you become champions. So you get into that later on. Then we also have the International Public Sector Accounting Standard Board. They are also there to issue the International Public Sector Accounting Standards, the IPSAS. Now, note that if you think, oh, I won't adhere to the IPSAS, you are lying, because Ghana has adopted the IPSAS, for which reason Ghana has issued Ghana has enacted the Public Financial Management Act 2016, Act 921. So what I'm trying to tell you is that, yes, even though we call these things as non-legal rules and regulations, and they are general and international principles, Ghana and other countries have contextualized these things and are enshrined in various acts. Hence, if you don't adhere to them or non-compliance to these general and internationally accepted principles, it can result into a legal action, a fine, a fee, or revocation of your license. So that is also the second thing that we must understand: non-illegal rules and regulations. Then we go to the third one, which is where we're going to be excited about this evening and spend some time on for Operation 6 marks to 10 marks in the exam hall. So Operation 6 to 10 marks in the exam hall. So when we talk about ethics, what do we mean? And when we say someone is supposed to act ethically, what exactly do we mean? So when we say ethical behavior, what exactly is that? And when we say ethics, what is it? So I'm going to just take you straight up into our book. Those of you with the book, you can go to page 30. From page 30, we're going to be sharing our thoughts from some of the things there as we jump over. So for one-liner definition purposes, we say that ethics are a set of moral principles to guide human behavior. Ethics are a set of moral principles to guide human behavior. A set of moral principles to guide human behavior. That is what we mean by ethics. So when we say ethical behavior, what exactly do we mean then? When we say, if ethics are a set of moral principles, then when we say ethical behavior, what exactly do we mean by ethical behavior? And that'll be down here, ethical behavior. Oh no, I think it's up. Ethical behavior, it's seen as the highest level of behavior that society expects. The highest level of behavior that society expects. The highest level of behavior that societies expect. So what are we saying here? Ethics are moral principles to guide human behavior. When we say ethical behavior, it is the highest level of behavior that societies expect. And ethics is ethics. Something that is wrong is wrong. Something that is right is right. There is absolutes when it comes to dealing with issues about ethics. Stealing is stealing. Okay? Fraud is fraud. You cannot coach it. You cannot do anything about it. So our focus this evening is not to talk about the law, because this is not a business law class. Our focus is not to talk about the non-legal rules, really, because we'll get into that pretty later on. Our focus is just to look at some of these international standards, international professional fundamental standards that guides the profession and how we can behave as professional accountants. So let's start the code of ethics. Like I mentioned earlier, the fundamental code of ethics, or the fundamental principles of the code of ethics, are issued by the International Ethics Standard Board for Accountants. Now, this is a subcommittee of the IFAC, International Federation of Accountants. And ICAG, that is the Institute of Chartered Accountants Ghana, is a member of IFAC. So ICAG has adopted those code of ethics. So now they have become the ICAG's code of ethics. Okay, they have become the ICAG's code of ethics. So when we say ICAG code of ethics, it's not something just anywhere. It's not something on any planet. It is just talking about the code of ethics you know from the International Ethics Standard Board for Accountants, the International Ethics Standard Board for Accountants. So let's go through them quickly, and then let's see how they are going to be. So number one, I'm going to list them down, then we take them one after the other. As a professional accountant, in everything you do, number one, integrity. We're going to get into that in a moment. Number two, it's going to be the issue about objectivity. Number three is going to be the issue about professional competence and due care. Professional competence and due care. Professional competence and due care. Number four, my favorite area, confidentiality. You like talking, go sell tomatoes in the market, or become a journalist and leave the accounting profession for the people who can keep quiet. Then professional behavior. Professional behavior. If there are any questions, you raise your hand, I bring you up, or you put it in the chat for me, and I'm going to be reading everything. So don't wait till I get somewhere before you draw me back. If there is anything, you make sure you raise your hand, I bring you up, or you put it in the chat for me, and I'm going to provide you with the answers that you need as we move. Okay, so these are the code of ethics. You have to adhere to this code of ethics, at least for the purpose of the exams. And because some of you, if we say adhere, you won't adhere. But remember, if you don't adhere, failure to adhere to some of the code of ethics, you will be punished. For instance, that is what we saw in the banking crisis, the audit firms, what happened to them. Or your license could be revoked, or you could be jailed if you find yourself in more developed countries. I mean, like the banking crisis that occurred in Ghana, if it is outside, people would have rotten in jail by now at the end of the day. But, you know, we are a developing country, we are now starting, and that was the first time something like that hit. So, I mean, we are now learning our lessons in that case. But hey, you need to adhere to these codes. Let's go. First, integrity. Integrity. What is integrity? The issue about integrity simply means that the professional accountant must be honest and straightforward. So this means the professional accountant must be straightforward, and honest in all professional work. That's the thing. You got to be straightforward, and you got to be what? Honest. My honest didn't come. And honest in all professional work. You got to be straightforward. You got to be honest. Say the truth. But the question we ask ourselves is, what does that mean? When you say be straightforward, when we say be honest, what does that mean? It means that as a professional accountant, make sure you don't provide misleading financial information. So you avoid the provision of misleading financial information. So misleading financial information provision must be avoided. That's what we mean by integrity. That is why you have to prepare the financial statement in accordance with the qualitative characteristics of financial statements. Okay, it has to be faithfully presented and it must be relevant. Okay, everything that is required to be included must be included. But if you don't know and you prepare the financial statement shadily or shabbily and lazily in a manner that mislead people and misinform people about the true nature of the entity, that means you are not being honest. That means you are not being straightforward. That means you are breaching the integrity principle. So misleading financial information provision must be what? Avoided. Number two, not only that, intentional, or let me put it this way, omission or misstatements in financial statements, misstatements in financial statements must be avoided. You cannot omit something because if something is relevant and you omit it, it's going to be misleading. Generally, it means that the financial statements do not then comply with the fundamental code of ethics. So if you omit something, you misstate something, what have you done? You are not being honest. You're not being honest. So don't provide any financial information that will be misleading. Do not omit or misstate anything intentionally. But then the big question we then ask ourselves is, okay, who should we be honest with? Generally, hey, tell me, who should we be honest with? Broadly, as professional accountants, we owe a duty of care to the public at large. However, our duty of care is primarily to our employer, meaning we owe a duty of care to shareholders, meaning that whatever we are providing to shareholders as professional accountants should not be misleading, should be honest, should be the truth and nothing but the truth, so help you God. So shareholders, we owe a duty of care to them. Not only that, we owe a duty of care also to the regulatory authorities. Now, when we say we owe a duty of care to regulatory authorities, what the heck is that? It simply means that, for instance, Ghana Revenue Authority, you don't lie to them about your revenues. You don't lie to them about your income. You don't lie to them about your expenses, because if you do that, what do? You are misleading the country. And now that the country is bleeding and we need more money, the last thing you want to do as an accountant is to mislead the GRA, because we can throw you in jail forever and ever. That's a joke. So GRA, we owe a duty of care to them. Then to other regulatory bodies, if it is a financial institution, Bank of Ghana, we must tell Bank of Ghana the true status of the company, the financial institution that we are auditing. If it is a savings and loans company, if it is an investment company, if it is a bank, whatever it is, we must report to the Ghana Revenue Authority. If it is an insurance company, the National Insurance Commission would have to be informed about it as well in our reports to them. Generally, broadly, maybe we can even expand this a little bit to issues in relation to Food and Drugs Board Authority or the Ghana Standard Authority. All right, because as professional accountants, if we realize that the entity is not complying with some of these things and they are not acquiring certain equipments they are supposed to acquire, and we know they have to do that, and we may be providing misleading financial information to these people and broadly to the public or the society. Please, public interest is not defined anywhere in the law. So before you think about anything that is in the public interest, you got to be careful that you seek a legal advice. Nonetheless, as professional accountants, we owe a duty of care to the public at large. Okay, people trust us generally. So you need to ensure that shareholders are covered well, regulatory authorities are covered well. We are not lying to them, and the entire public, you're not lying to them. That is what we mean by integrity. Professional accountants must be honest, must be straightforward in all professional dealings. Must be honest, must be straightforward in all professional dealings. If there are any questions, you raise your hand, I bring you up, or you put it in the chat for me. Then we go to the second one, objectivity. Objectivity. As professional accountants, we're going to be exercising a lot of professional judgments in our work. For instance, how much should we provide for a legal, a court issue? How should we recognize revenue? Even though there are standards there, the IFRS 15 is there, there are situations where we have to use our own professional judgments. What is the depreciation method we should use? Okay, that is a professional judgment. When it comes to valuation of inventories, should we use first in, first out, or last in, first out, or weighted average method? When we are preparing the financial statement, we're going to be making all these professional judgments. The issue about objectivity is that when a professional accountant is exercising these professional judgments, he must ensure not to allow bias, conflict of interest, and undue influence to affect these professional judgments. That is what we mean by objectivity. That is what we mean by objectivity. So it means not to allow bias. It means not to allow bias, conflict of interest, and undue influence to affect professional judgments. Conflict of interest to affect professional judgments. Like I said, you will be making professional judgment on various issues. When you are making those judgments, please, thou shall not be biased. That's the first thing. When we say you are biased, it means that you are doing things to protect the interest of some people. So protecting the interest of others, that means you are being biased. Are you getting it? So you are protecting the interest of others and placing the interest of others ahead of other people. That means you are being biased. So don't try to do anything that protects other people's interest, that promotes other people's interest, so that you don't be biased. But not only that, there is also conflict of interest. Conflict of interest is where your benefit or your interest gets into the way of the professional judgments. Okay, so it is where the personal interest of the professional accountant, interferes with the interests of the entity. The interest of the entity or shareholders. So conflict of interest or shareholders or other stakeholders. That is conflict of interest. So for instance, your CEO calls you and say, hey, listen, GRA is coming around next week. Make sure that the revenue is understated so we don't have to pay a lot of tax to the GRA. Okay, make sure revenue is understated so we don't have to pay a lot of tax to the GRA. Now, if you're able to do that, we will be able to promote you so you get more money, or better still, we will be able to give you that vacation that you've been waiting for all this while and give it to you. Because I mean, this money, when we give it to the government, we don't know anything they do with the money. Again, that is just an example. What does that mean? It means right now, where your boss has put you, you're going to be thinking about yourself. Do you want your bonus? Do you want that promotion? Do you want that vacation you've been waiting for to take your wife on, or your husband on, or your children on? Or you protect the interest of GRA, taking the right amount of tax or paying the right amount of tax to the GRA? Which one are you going for? Your interest or the interest of the GRA? So if you allow your interest to come in the way ahead of the interest of the shareholders, the interest of the other stakeholders, that is what? Conflict of interest. Then the last thing is certainly undue influence. Undue influence. So what is undue influence generally in that case? What is undue influence? So bias is you are protecting others' interests. Conflict of interest is where your own interest is antagonistic with the interest of the entity, the shareholders, or others. Undue influence is where the professional accountant is under pressure to act inappropriately. Okay? So there is pressure to act inappropriately. Pressure or force to act inappropriately. To act inappropriately. That is what we mean by undue influence. So these three things will affect your professional judgment, will affect whether you accept something or you don't accept it. To will affect the way you prepare financial statement and the way you reach conclusion on various items. What we are saying here is that make sure that you don't protect others' interests. Advocating. Make sure that you don't have your own interest conflicting with the interests of the company. Self-interest threats. We'll get into that in a moment. And then undue influence. Make sure there is no pressure on you to act inappropriately. Now, remember, you're going to have pressure. But as always, as a professional accountant, no pressure is a pressure. No pressure is a pressure. Now, if you have to do the right thing and lose your job, do it and lose your job. If you have to do the right thing and be sacked, do it and be sacked. Even if you have to do the right thing and be killed, do it and be killed. That is what we mean by adhering to the code of ethics. So you have to ensure that in your professional judgments, no bias, no conflict of interest, no undue influence, because that is going to be affecting your objectivity as a professional accountant. That is the second thing, objectivity. If you have any questions, you raise your hand, I bring you up, or you put it in the chat for me, and I'm going to take it for you as we proceed. Okay, number 3, and it's getting exciting. Number 3, it's going to be professional competence and due care. Professional competence and due care. Professional competence and due care. I'm seeing the chats coming in. Is Nhyira from different, what? Is Nhyira from different planets? Why? The way I'm saying, if you do, you have to do the right thing to lose your job. Sure. As ethically, you have to do the right thing and lose your job. If you lose your job, God will take care of you. If you lose your job, come, I'll give you salary for 6 months. Tell me your employer, I'll catch you. All right, so let's go to professional competence and due care. You can see that I brought up a chart there because I want to share my thoughts on this one-liner definitions here. So make sure you flow with me there. So what is professional competence? Competent. So when we say someone is competent, like in our political parlance, I mean, previously they said somebody was not competent and they have the men. Now the men that they have, the economy is also doing something. So are they competent? We don't know, but we are accountants. Let's think about accountants. So when we say competent, what does that mean? Professional competence simply means to maintain professional knowledge, skill at the level required to ensure competent professional services based on current development in practice, legislation, and techniques. That is what we mean by professional competence. In other words, you should possess the requisite skills, the requisite knowledge, the requisite expertise for the job so that you can do the work to meet the standard that is supposed to be met. That is what we mean by professional competence. Professional competence. Then the second part is, you can be competent. Now, professional competence is achieved through education. Okay, you got to educate yourself. That is why you're doing this course. One of the things you're doing here is working on your competence so that you understand the IFRSs, you understand the IASs, you understand the various things. That is education. Your competence is also built. If you become a chartered accountant, that is not all, because you attend various CPDs, continuous professional development. And these are also going to mark towards your qualification and membership status in the ICAG later on. So continuous professional development is also going to be there, generally, that you have to attend. And generally staying up to date, being alert and staying up to date with current issues and current developments that are happening in terms of changes in laws, changes in acts, and various changes that are occurring, you need to adhere to them. That is what we mean by competent. That's what we mean by competent. 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 Then we come to the next one, that is due care. Now, somebody can have all the education in the world. Somebody can have all the qualifications in the world, but the person sucks. The person doesn't have the capability to do the job in the manner that is expected. So due diligence or due care means to act diligently in accordance with applicable technical and professional standards. To act diligently in accordance with applicable technical and professional standards. To act diligently in accordance with applicable, technical, and professional standards. That is what we mean by due care. But then the question we throw to ourselves is, what the heck is diligence? When we say someone has to be diligent, what exactly do we mean? So I'm going to take you down the rabbit hole here and explain diligence to you in a moment here. Let's see if I have what I wanted to share on here. So we see here that you carry out the work to proper standards. You keep up to date with changes in legislation, methodology, and what? Various regulations at the end of the day. Yes, Timothy?
Yes, please, under the point objectivity, your point 3. So the point, the first one, integrity. The point 2, omission and misstatements. This point is like, I think it's fall under due care or professional competence, because if the person has the competence or is work in what is expected of him, I think omit the information that is needed or mistake the thing unintentionally. Because maybe the person not aware, but because the person not have the competence or having like they don't have the ideas, so the person not do what is expected in accordance with it. Oh.
You have a point, but that is not the truth in its entirety. Because when we talk about omission and misstatement here, we don't only mean intentional. There could be omission because the transaction was not seen, was not available, or the documents were not there, so we couldn't see it. That doesn't mean we didn't do our work well. No, it's not there. I mean, how do you enter something that is not there? So that is why in IAS 8, accounting policies, changes in accounting and estimates, we have prior period adjustments. So you realize that they did an omission about something last year, or they did a misstatement about something last year. Then in the subsequent year, they now recognize it, or a fraud occurs. But at the time we are preparing the financial statement, we did not see it. But later on, when we see it, what do? We correct the financial statements. So it's not true that if something is omitted, it means the person is not following the due care principle, or if it's misstated. Maybe based on the information available, that is why it was done in that manner. So it's not always the case in that case.
All right. Thank you.
Right. So that is the third thing, professional competence and due care. Doing the work in a manner that is expected to be done. I'm seeing a chat coming up. Kweku said, how about if they are competent but deliberately does so, mistake and omit? Yeah, so that means they are not diligent. So that's where due care comes in. Okay, so you know it, but you did not do it. Why didn't you do it? Probably because of pressure, or because of some self-interest you had, or because of some familiarity issues. Does that make sense? So these are the threats that we'll discuss in a moment that we'll talk about. So when we get there, you will see. So sometimes they can qualify, but they would deliberately do so because of a relationship, because of a threat that they are under in that particular case. Then Fred Johnson said, which of the books are we learning from? This is from our financial reporting book you can buy at 120 cedis. So it's from our financial reporting book. That is where we're taking the materials from. Then the last one there, quickly let me know if that makes sense. Chief Issa said, can you report a company for sacking you for your integrity? Yeah. But, Agbalagba can come after you. And I'll talk about Agbalagba later on. So, yeah, you can report them. You can sue them for unfair dismissal. Do you get it? You can sue them for unfair dismissal. And you will win if really they have unfairly dismissed you. And if in the court you have the balls to say what they did and why you did it. And remember, as you take those actions, the threats coming on you will be bigger, because that will affect the reputation of the company. It will affect the reputation of the management of the company. And you are now trying to tell the regulators that, oh, this company doesn't adhere to legal things or the right things. And so that is why they sacked you. So as you do that, you must understand that there is a bigger threat you are exposing yourself to. But hey, you can sue them in the courts and you will be settled. And that is why I said, after you are settled, Agbalagba can come after you. That one is the local way. We send you some message through the Wi-Fi of the sky and you will get it wherever you are. You will get it by all means. That's just by the way. The next one, confidentiality. Confidentiality. Now, as you carry out your work as a professional accountant, you're going to come into contact with a lot of information that you don't have to disclose. Now, so you have to keep quiet. So confidentiality simply means not to disclose information to third parties without the permission of the client entity. Why? Because in your professional work as a professional accountant of the company, you're going to come across the salary of the board of directors, the incentives that it gets. You're going to come across various information. What we are saying here is that thou shalt keep mute unless you are asked to do so. So the boys, Sunday, they are drinking club beer and pork meat. Then they are talking about companies. You don't do that. Because you see, the issue is that if you trust somebody, that person also trusts another person. So you don't tell anybody. Charlie, this company, they see where you see it is that pastor. No wonder that pastor, look at the car he's driving. The salary they give to this man, but I don't see the work that he is doing. Hey, is it your company? Is it your money? You to go and open your company. So you got to keep quiet. You got to keep quiet. However, if the entity is doing something illegal, like the question, was it Kweku? No, Isa asked, if the company is doing something illegal, something that is unacceptable, something that they are not licensed to do, that one you can talk, but you don't tell your friends, you don't tell your wife in the bedroom, or you don't tell the girls at the salon. You go and tell the responsible regulatory authority and report the issue to them. But before that, you need to seek legal advice, because like I said, when you make such attempts, a court case may be hanging on your head, or local agbalagba may be thrown at you. So that is the issue about confidentiality. So it means not to disclose. It means not to disclose information. It means not to disclose information of the employer to third parties without permission, unless the professional accountant has a legal or ethical duty to do so. Has a legal or ethical duty to do so. Does that make sense? That's confidentiality. So you can talk, but it is when you have a legal or ethical duty, like the company is doing something illegal, then you can say it. So there are some exceptional there, as you can see in the book from page 34. There are some exceptional rules there. Number one, you can disclose, or disclosure is permitted by law or is authorized by the client. So it is permitted by law, you got to say it, then you go say it. The disclosure is required by law because you are a key witness in a legal proceedings. So for instance, GN Bank and Unibank, those court issues, if you are the accountant of the company and you are a witness, when you stand in the witness box, and you hold to the Bible or the Quran and you say, I stand here to say the truth, nothing but the truth, so help me God, you got to say everything that has to be said, because this time around, if you don't say the right thing, you are on your way to jail. Literally, one leg is already in jail if you don't say the right thing. So the disclosure is required by law for legal proceedings. Why not? You disclose it. Then there is a professional duty or right to disclose, because maybe you are before the disciplinary committee of the ICAG for something you did. So you have to disclose, because that one, you have a professional duty to do it. Or because of the fact that sometimes the entity is doing something that is not right to be done, you have that professional duty to also disclose it to the regulatory authority. So to respond to an investigation by a regulatory authority, to protect the professional accountant's interest in a legal proceeding, or to comply with ethics requirements at the end of the day, or ethical requirements at the end of the day. So these are the circumstances under which you can still say it, but you will not be penalized and you will not be held responsible for saying something that you are not supposed to say. Kweku, your hand is up. You can come up. Yes, Kweku, your hand is up. Or it's audio hands. Okay. Oh. Let me continue with my thing.